Fitch has a stable credit outlook for Australian and New Zealand local and regional governments in 2023, although we expect the operating environments in both countries will be weaker compared to 2022. This is on account of downside risks related to macroeconomic conditions, such as high inflation and continued tightening in monetary policy by central banks, leading to a lower growth environment. Both Australia and New Zealand emerged from the pandemic relatively well, with strong economic indicators such as low unemployment and robust consumption, which enabled stronger fiscal performance by LRGs compared to earlier estimates. Even so, the impacts of a number of economic factors, such as rising interest rates, price falls in the housing sectors, and weakening business and consumer sentiment, will present more challenging conditions in 2023. These factors will weigh on fiscal outcomes for Australian LRGs, although we expect them to be manageable, while New Zealand LRGs will be less impacted. A softer economy in 2023 could bring about larger fiscal deficits for Australian LRGs and a delayed return to healthy surpluses, along with a sharper rise in debt via lower revenues and as governments look to additional measures to provide cost of living relief. However, we expect LRGs will have some capacity to respond to fiscal pressures, such as via more disciplined spending than currently budgeted, to avoid material impacts on credit quality. The operating performance of New Zealand LRGs will be more resilient to a softer economy in 2023. We expect any cost pressures, including from inflationary impacts, will not significantly affect local government budgets and will be offset by stable revenues and flexibility to increase these if required. Pandemic-related spending by Australian LRGs has driven debt higher, a trend we expect to continue in 2023. The rise in debt is counterbalanced in part by continued economic growth and a likely return to sustained operating surpluses over the medium term, although 2023 will see leverage remain materially weaker than pre-pandemic levels across most LRGs. Debt as a percentage of GDP will likewise increase, although at a more moderate pace. We expect the impact of borrowing costs of Australian LRGs from higher interest rates to be limited in 2023, given their high portion of fixed-rate debt and long-term debt profiles. For New Zealand LRGs, supply chain disruptions will continue to challenge CapEx programs as labour shortages and cost and availability of materials have an impact on plans. CapEx is likely to be elevated across the sector as councils accelerate spending following restricted activity during the pandemic, which will create additional indebtedness and upward pressure on leverage. Councils generally have balance sheet capacity to keep leverage manageable. However, prolonged or deteriorating supply chain challenges may result in higher debt and leverage beyond current expectations.